Every prompt you type and every image you generate relies on massive amounts of data physically moving from one server rack to another. The entire artificial intelligence boom depends on a hidden, physical infrastructure of cables, switches, and optical connections. That makes Marvell Technology the plumber of the data center ecosystem. While NVIDIA gets the headlines for building the ultra-fast GPUs that compute the data, Marvell builds the specialized networking chips and custom silicon required to actually move that data around the building. But knowing a company is important doesn't automatically make it a smart place to put your money. If you misallocate capital into the wrong hardware stock right now, you can easily lock yourself into years of dead money. The primary danger is the AI premium. Right now, market excitement artificially inflates the entry price for almost any business associated with a data center build-out. This chart shows Marvell's stock price over the last 24 months, mapped against a broad semiconductor index. You can see exactly where the market realized Marvell's role in AI and where its pricing diverged entirely from the standard semiconductor baseline. To figure out if paying that premium is a dangerous trap or a calculated opportunity, you have to look closely at how Marvell makes its money. When you buy a share of Marvell, you are buying two completely distinct businesses bundled under a single ticker. On one side, you have a hypergrowth engine. Data center networking demand is accelerating, creating a massive upside for the optical chips and custom silicon Marvell designs. On the other side, you have their legacy business. Marvell still supplies heavy, slow-growth sectors like enterprise networking, carrier infrastructure, and traditional telecom. This creates a mathematical tension. You have to decide if the explosive revenue coming from the data center side is large enough to justify both the inflated AI premium you are paying today and the heavy drag of that legacy telecom baggage. The first major trade-off involves your entry price, measured by a metric called forward PE, or price-to-earnings ratio. Forward PE is simply the mathematical cost of admission. It tells you exactly how many dollars you are paying today for $1 of the company's projected future earnings. If you choose to buy Marvell right now, your input on the ledger is allocating capital at a historically inflated multiple, driven entirely by the market's enthusiasm for AI. The outcome of that input is that you secure highly targeted, direct portfolio exposure to the surging demand for custom AI silicon and electro-optics. The trade-off for that exposure is the constant threat of multiple compression. If broader market sentiment shifts, the stock price can drop sharply to correct that inflated multiple, even if Marvell's actual business remains perfectly profitable. This chart shows how fragile that balance is. Because you paid a premium, you lose your margin of error. If broader tech sector capital expenditure slows down even slightly, the scale tips and the multiple compresses violently. Paying the AI premium means accepting asymmetrical risk. You get highly targeted silicon exposure, but you leave your capital completely vulnerable to minor macroeconomic slowdowns. The second major hurdle comes from the legacy half of the company, which forces you to deal with cyclical down cycles. This chart illustrates a traditional cyclical down cycle. Customers overorder telecom and enterprise chips. Inventory stacks up, and demand drops into a valley until those stockpiles are depleted. Your input is the discipline required to hold the stock through these ongoing slumps. The desired outcome is catching the sharp cyclical rebound. Once old inventory clears out, orders flood in, and revenue spikes back up the other side of the wave. The trade-off for catching that rebound is enduring long periods of underperformance. You will sit on dead money in the short to medium term while you wait for the telecom and enterprise markets to correct themselves. Pure-play AI stocks move fast. Marvell's legacy exposure forces a waiting game. If your portfolio requires immediate, across-the-board revenue growth today, this structure simply will not work for you. This brings us to the structural alternative, taking a concentrated, single-stock position in Marvell versus buying a broad semiconductor ETF. Your input with Marvell is highly concentrated capital. You are betting specifically that networking bottlenecks will remain the primary obstacle for AI advancement. The outcome of that bet is maximized leverage. If networking speeds remain the choke point, your outsized returns will beat a diversified fund. But the trade-off is the total elimination of passive investing. Holding a single hardware bottleneck stock means you are now required to accurately predict hyperscaler capex. Hyperscaler capex represents the massive spending budgets of tech giants like Google, Amazon, and Meta. Because they buy the servers, their quarterly budgets dictate Marvell's future revenue pipeline. An ETF allows you to passively participate in the semiconductor boom. Owning Marvell is effectively a part-time job. You will have to actively monitor big tech earnings calls to ensure those data center budgets aren't shrinking. Evaluating the stock in a vacuum only gets you so far. The final step is determining if Marvell actually fits inside your specific portfolio strategy. This allocation matrix maps decisions based strictly on your personal risk tolerance and timeline. If you're a value investor requiring a clear margin of safety and consistent dividends, your path leads directly down to a red avoid verdict. For the value investor, the AI premium is a deal breaker. Because the optimism is already baked into the stock's price, your margin of safety has been completely destroyed. However, if you are a growth investor lacking networking exposure, your path diverges. With a high risk tolerance and a 5-year timeline, Marvell lands cleanly in the green core growth position box. Marvell's utility is entirely subjective. It is a terrible high-risk buy for the value investor, while simultaneously serving as a logical high-conviction play for the growth chaser. That leaves the long-term compounder. You sit in the middle. You don't have the time to track quarterly budgets, but you still want exposure to AI infrastructure. Your verdict is hold as diversifier. Allocate a small percentage here, but it is strictly contingent on your ability to ignore the next 5 years of cyclical volatility in their telecom sector. That is the ultimate reality of Marvell Technology. It is a hyper-growth AI darling chained to a heavy, cyclical legacy chipmaker. Successful investing isn't about finding a definitively perfect stock. It is about taking a hard look at an asset's specific structural flaws and ensuring those risks align with your own financial timeline.